Yes, good evening, everyone. Good evening, all of you. We'll be starting in a few minutes. Still early, a little early. Meanwhile, do let me know if my audio is clear. Yes, good evening, friends. Welcome, all of you. Let me know if my audio is clear to you. Yes, please. It's time. We'll start. Okay. Good evening, everyone. This is CA Devang Kothari, and I'm here to discuss the entire paper of July 21. That is costing paper, CA final costing paper of July 21. We'll have an in-depth discussion, in-depth solution of the entire paper in these 2 hours right now. Yeah. Okay, before that, let me congratulate all those of you who appeared for these exams in July 21. Yes, it was tough and it was under lots of varied situations you attended the exam. Some people have attended the exam walking through the rains. There were heavy rains at many parts of the country, and also the pandemic is still not very much over, and still you people managed to give the exam. That is appreciable. Hats off to you. Yeah, and I hope you enjoyed writing the papers. Yes, the paper was very good, especially I'm talking about the costing paper. I've told you yesterday in my video that the costing paper was really a good paper, but it was a pretty long paper, and it was again focused mainly on practicals. Yes, as usual, as I have shown you comparison of the previous past papers also, even in the past three exams, you had seen my comparison that mostly the paper is practical questions only. Yes, CA final costing subject is not a theory subject, it is a practical subject. Yeah, we'll start off with the paper discussion in a while, in a minute. Before that, let me make some announcements here. Yes, I have now joined Unacademy along with other faculties at Yeshas Academy. Yeshas Academy is now collaborating with Unacademy for providing 100% complete English comprehensive batches. Yes, now certain benefits of Unacademy you can get, like one single subscription, you can access any subjects. Yes, we don't charge subscription subject wise, you have to pay group wise. You pay money for group 1 subscription, you can watch any subjects of group 1. Yeah, there will be live interactive classes, live sessions we will be conducting. Recorded sessions are also available in case you miss the live recording, live session. Multiple educators you will get for different subjects, and doubt solving sessions will have once in every week, and mock tests are also there. CA final group 1, your pricing will be like this, and you can subscribe for 1 month, 3 months, 6 months, 12 months, 24 months, 36 months, anything you can subscribe. Or group 2 also you can get similar options, or you can also get combo of group 1 plus group 2. You can opt for combo of group 1 plus group 2 and use the code Yeshas Live. Use the code Yeshas Live, it will give you further 10% discount on these subscription prices. My personal suggestion, what you can do is, those of you who are still having exams to give, you can go for a combo subscription for say 2 years. Now 2 years combo subscription, trust me, all subjects of CA final can be completed very easily. Yes, that is what I would suggest. And soon we are also launching Iconic subscription for CA final. Iconic is an advanced subscription for Unacademy students. It will be priced a little higher, but it has lots of benefits. You'll get the details of Iconic subscription as soon as we launch them. In case of Iconic subscription, your plus subscription benefits are all included. Over and above that, you will get dedicated doubt solving. You will get printed books from Yeshas Academy. You will get test series, and you can connect with peer groups for doubt solving with professionals. Yes, these are all like added benefits of the Iconic subscription. Anyways, these are the benefits of your Unacademy subscription. So please log on to Unacademy, check out free lectures as well as paid subscriptions on Unacademy. Now, going back to our paper analysis. Well, yes, July 21 paper of CA final costing. First of all, let me show you an overview of this entire paper. This is my overview for the entire paper. Excuse me. Notice Total these many questions in the paper, and I have shown a color coded comparison for this entire paper. And if I give you a summary here, yes, out of the entire paper, almost 86 marks of the paper was out of my book, was mostly related from our material, from the material that we have done in my regular class. Yes, so those of you who have attended my regular class, you must have found at least 86 marks out of our routine material, plus another 29 marks were similar to the questions that we have done in class. And one question, just one question of 10 marks was like completely new, beyond anything that we have done in the class. Yes, baki rest all the marks were similar to the things that we have done in a class. So apparently I can say that yes, the paper was easy, but the problem is that paper was pretty long. And you know, the papers are always easy. What is incomplete is mostly your preparations. Trust me, if you have studied my classwork book, if you have attended all my classes and covered up all my classwork questions, then trust me, these 86 marks, out of these 86, you could have easily got say 60 plus in that, if you have prepared everything that we have done in the class. It was that easy. But anyways, I'll show you what were the questions in the paper. Question 1 was a 20-mark case study. It was from chapter number 2. And it was regarding business excellence. It was the EFQM model we've done in class, and in fact we have done an exact similar case study in the class. During my classroom discussions itself, we have done a similar case study in class. Yes, in class only we have discussed it. That was on page 2.28 in my latest book, case number 3. Look, all these references that I have given here, these are references out of my March 21 book. Yeah, if you want, you can join my Telegram channel, and by tomorrow I will be posting my March 21 books on my Telegram channel, free for anyone to use. Plus I will also be posting this paper discussion sheet on my Telegram channel. Yes, this paper discussion, whatever I am making, I will post this on my Telegram channel by tomorrow. So please do join the Telegram channel. That was question number 1. Question 2, another 20-mark question, is from chapter 1, and this was exactly word to word from our book. Again, a classwork question. Again, this was a classwork question that my students, we have done that in a class. It was word to word from our book. That is on page 1.35, question number 4 is what it was. Then question 3. Well, question 3 ABC were little new, but it was a general calculation involving residual income and return on investment. Yes, that is from chapter number 7 as per the new syllabus, but as per your exam it was chapter number 8. Yes, for November 21 exam onwards, chapter 5 has been removed, so accordingly remaining chapters, the numbers have changed. Okay, but this was question 3 ABC were of 14 marks from chapter number 7, that is performance measurement and evaluation. The question was simple calculation of residual income and ROI. I'll show you the workings and we'll see the answers. And question 3B, okay, this is a mistake. I can cancel this off. That page number reference is wrong over here. It is not from the book. But question 3D. Question 3D was again from chapter number same chapter, chapter 7, and it was a direct theory question, and you have that same question in a case study of my book also. Yes, that same case study, that same question is there in our book also. I'll show you that. It was regarding non-financial performance measures. It was a general discussion, general theory about non-financial performance measure. Yeah, you just have to write a general benefits of that non-financial performance measure. Then question 4, part A, was a practical question about discount or surcharge. It was basically from pricing decisions chapter. Yes, it was not discussed anywhere in our class, but it was a general question about, it was a kind of a very general kind of question, and a similar case study we had in ICAI study material. Not discussed in my class, but it was a very general discussion. I'll talk about it when I discuss. Question 4 or question. Question 4a, there was another or question there, which was from chapter 1 theory. It was value chain analysis, identifying the activities. Remember primary activity, secondary activity? Yeah, it was about that primary secondary activity. You just had to identify that which activity is what. Yeah, and that was a basic level question again. Question 4b was a theory question about environment management accounting. Again, this not discussed in my class, but unfortunately it is there in ICAI study material. Yes, word to word question is there. I have not covered up in my book, in my class, because this was a very generalized answer about environment management accounting. We'll discuss that when we talk about the paper. Question 4c was a practical question of multinational transfer pricing. Again, a question exactly from my book, similar to the question in our book, very much similar to the question in our book, and that was also discussed in my classwork discussion. Yep. Page reference I have given there. Question 5a was again a practical question about theory of constraints, and a similar question, pretty much similar question also we have in our class on page 2.48, question 11. Question 5b was a direct theory question about beyond budgeting. A simple theory question about beyond budgeting and various aspects about beyond budgeting I've given in theory of my book. That same word to word you are supposed to write. Question 6a was a practical question about make or buy, a basic question of make or buy, similar to many questions we have done in class. We'll discuss the solution here. And question 6b was a new question about overhead variances. As such, even in that question, calculation was not new, but the problem is the names of variances they had given was little new. The variance names that they had given were pretty much new, so it turns out to be little difficult question there. But on the whole, rest all the questions were pretty much easy and simple to understand. We'll start discussion of that paper. Do let me know if my audio and visuals are clear. Yes, Francesca, March 21 is the latest edition of my book. Okay, we'll start the discussion. First question 1. Okay, just a minute. I think there is some video lag that you are observing. Let me know if you are you observing any video lag on YouTube? Okay, you say not now, so I presume now there is no video lag. Francisca, my book, I will put it on my Telegram channel for free access. I don't sell my book. You'll be getting the book soft copy on my Telegram channel. I'll be posting it tomorrow. It's already there on my Telegram channel, but I'll just post it again tomorrow on my channel. Anyways, yes, we'll start. Chalo, question number 1. Now, question 1 is a detailed case study that they have asked. Now, look, I need to complete this paper discussion within these 2 hours time from 8 to 10. So, I will not be reading the entire question 1. I presume that those of you who have given the exam, obviously you have read the entire question. I'll just point out some important points in the question just for you to notice. Yeah. So, check out. The question 1 is regarding a finance company, Paul Finance Limited, and it is into the business of giving loans, various types of loans it is giving, and it is also giving like EMI facilities and all. Okay, so that is the main business of the company. It's most diversified and profitable non-banking finance company. Okay, it is pioneer in introducing interest-free EMI finance option. They have also pioneered, this was the first company who pioneered in giving interest-free EMI finance options in more than 50 categories of consumer durables and other products. Now it wants to foray into wealth management. So now they want to get into the business of wealth management. What exactly is wealth management? Wealth management is basically assisting customers for their savings and investment requirement. You assist the customers and suggest them, advise them that you make investment here, you make investment there. Yeah. Okay. Now when they thought about its strategy to achieve a big goal, the main focus was an important element. The main focus was that what strength of our past do we want to carry in the future. So they wanted to study that what are the strengths of their past performances. My Telegram channel name, Devesh, is my name, CA Devang Kothari. Yeah, my Telegram channel name is CA Devang Kothari. Give me a minute, I'll just post the Telegram channel link also on the live chat window after a while when I take a short break in between. Right now, let us continue with this discussion. Of all the options, one thought resonated that reflecting all outcomes over the course of its existence is sustainability. In short, the question is mainly focusing on this sustainability. They want to prove that their business is having sustainability. Okay? To press with the idea further, the CEO has narrated 4 of its achievement over the period to the group chairman, Mr. Sarva. Okay, so the CEO has narrated 4 achievements to Mr. Sarva. Mr. Sarva is the chairman of the entire group of companies. So notice what 4 achievements has the CEO mentioned about. The CEO first mentioned that their focus is on existing customer needs. Yes, they say that the company does not focus on getting new customers. Rather, they believe that we will less worry on getting new customers, so that we'll focus more on the existing customers. They are believing that more products per customer can be achieved rather than more number of customers. That is one achievement that they have posted. Then innovation, the CEO also says that they have innovated many new technologies, like they innovated a spot approval for the consumer durable finance. Spot approval means approval will be obtained within just 3 minutes as per their calculations, and they are now down to just 1 minute for approval of consumer finance. They have added another partner to the lifestyle finance portfolio, so they have adding more and more partners in their business also. They have also started online portal for loan account statements and loan servicing and all. These are all the innovations that they have done. Further, he says about technology that they have adopted new and emerging technologies. They have adopted many new emerging technologies which enables customers to transact without restriction. Online facilities and online technologies they have adopted which will help the customers to transact easily. The customer can apply online, can get a statement of accounts, can get every single detail of the loan, access anytime, anywhere. They can even foreclose the loan and borrow back the same amount, borrow back the amount which they have repaid. Again, everything through the help of technology. In short, these are all the achievements he has listed. And they have also built partnerships to achieve the best practices. They have partnered with various other organizations, like they have partnered with an organization called NEEL for online capabilities, partnered with Tapas for software purposes. Sita is the partner for process mapping. Prajna is the entity who is partner who is auditing us. So various business partners they have associated with. And as a result of these practices, in the current financial year, your performance has improved as follows. They got new loans increased by 17%. Customer franchisee grew by 24%. These are all the achievements they have given. Asset under management, AUM, stands for asset under management, meaning like total number of loans given, that has grown by 27%. Total income increased by 34%. Net interest income increased. Operating cost also increased, but total operating cost to net income ratio improved from 33%, improved to 33% from 35%, and profit after tax has grown by 32%. These are all the achievements they have mentioned. Because of these, the shareholders are happy, customers are also very much satisfied. But now the CEO was questioning relevance of business excellence model suggested for PAL. CEO is questioning that do we actually need a business excellence model? The case study is about business excellence. Mr. Sarva, who is the group chairman, who is known for his critical observations by his very nature, posted to the CEO on the prevailing insights of the wide group. The group philosophy of the business revolves around four under-mentioned principles. Look, Mr. Sarva has mentioned that the group philosophy, meaning the philosophy of the entire group of companies, involves four principles. Number one, sustainability. Sustainability meaning you need your business to be sustaining long term. Okay, sustainability. Present success does not guarantee future sustainable success. Present success does not guarantee the future. Sustainable success is crucial and complicated factor. The essence of any business model is to be proactive rather than reactive. Being proactive rather than reactive is a group philosophy. And excellence in business cannot be attained if the staff are forced to conform to certain norms. And whatever be the business model that suits the organization, it is not to be taken as a one-time exercise. Business excellence is not a one-time exercise. It keeps on improving. You have to keep on improving on that. That is the principles under the group's philosophy. This is about this is necessary for one of the question that they have asked. Okay, anyways, the required part in the question, if I summarize, they have asked a few things which is similar to case number 3 of chapter number 2 that we have done in a class. Yes, we've done this case in a class which was about business excellence. We have discussed that entire case in my classroom discussion. It is about that same thing. Based on the facts given above, you are requested to analyze what Mr. Sarva has intended to convey to the CEO of PAL and why in just 2 lines. So what is the group chairman trying to tell the CEO? Well, it is just a 1 mark question, so very short answer in just 2 lines I will describe. Well, the CEO in this company is boasting about the achievements. He's saying that we have achieved this, we have achieved that, we have achieved this profit, that profit, everything. Yes, but you notice that most of his achievements written here is all financial achievements. All the achievements that he has listed here, most of these are mainly financial achievements. He has not mentioned anything about, say, customer satisfaction. He has not mentioned anything about, say, employee satisfaction. Yes, now the group CEO is giving, the group chairman is telling the CEO about the group philosophy, because he is trying to tell the CEO that business excellence is necessary to implement. He's trying to tell the CEO that current performance is good, but that does not guarantee the future performance. He's trying to tell the CEO that in your company there has to be something for the future. The CEO has given so many achievements of the past, but he is focusing mainly on the past. Has he planned anything for the future? No, there is nothing mentioned in that CEO's achievements that what does he plan for future growth and sustainable business. That is what Sarva is intending to convey to the CEO. Okay? Second, explain briefly what is meant by business excellence. Basic meaning of business excellence is what you write there. If you happen to be the group chairman, evaluate each of the group's philosophy of the business revolving around the above forementioned principle to the CEO of PAL Finance to make him understand the relevance of business excellence model to an organization. In short, you just have to explain again these four principles. That how are these four principles relevant for business excellence? Well, we've done some theory about business excellence. I'll show you a few things, chalo. Regarding business excellence, we have the basic theory which goes like this. This is from my book. Regarding business excellence, you have a topic about fundamental concept of excellence. These are all the fundamental concepts of business excellence. Then there is criteria and enablers that we have discussed in business excellence. But these fundamental concepts of business excellence, you notice in these fundamental concepts that sustaining results is necessary. Sustaining results is important. It is not a one-time exercise. The whatever you do has to sustain for long term. That was one of the philosophy over here. Sustainability is the first philosophy. Then essence of any business is that you have to be proactive rather than reactive. So there has to be a future plan. Proactive means you plan beforehand that when something goes wrong, what will you do? That is also required for business excellence. Your staff should not be forced to conform to certain practices. You need to ensure that your staff is happy. You need to lead with vision, inspiration and integrity so that your staff is having good motivation and all. You need to succeed through the talent of the people. All these are the principles under business excellence. And business excellence is not to be taken as a one-time exercise. Naturally, business excellence is not one time, it keeps on happening continuously. In short, for that question, you just have to explain these 4 points to the CEO. You need to explain him that these 4 principles he has missed out. You need to explain him that he missed out these 4 principles. These 4 principles are necessary for business excellence. Okay. And then the main part of the question starts. Look, part A, B and C was just a general discussion. Then part D, E and F is the main part of the question, which we have exactly done in one of our classwork questions. I can even show you that question here. Yeah, that was case number 3. It was exactly case number 3 in chapter 2 of my book, and almost same question they have asked. Dekho, list the tools available to achieve and sustain excellence. That is my question here. List the tools available, meaning you make a list of all the business excellence models. Total 4 different models we have described in class. Just give the names of all 4 models. One of that model is the EFQM model. Part E in the question is asking you to explain fundamentals of EFQM model. Yes, so all these fundamentals of EFQM which you have in theory, you just have to describe all those fundamentals. You can describe them with respect to the details of this company. Yeah, and fourth, last part, it's asking you enablers and result. Again, as per that EFQM model, this is exactly as per the case study. Fundamentals and criteria. Criteria means enablers and results. It's exactly as per the case study 3. Look, the questions in my exam, the questions in this exam which were similar to my classwork discussions, I will not discuss them in detail right now because we don't have that much time, but I'm just giving you a cross reference. You can study that from my regular classes then. Done? Yes. Okay, that is your question 1 case study of 20 marks. 9 marks is just for describing the fundamentals of EFQM. That is directly from the theory of the EFQM concept. Done? Okay. Then question number 2. Well, question 2 was exactly word by word from our classwork book. It was exactly word by word from my classwork chapter 1 question number 4. Now, because it is exactly word to word same, I will not be discussing that solution right now because I know many of my students here, you are waiting for the solution to the questions which were new. So this question, I will not discuss the solution here, but I'm just giving you a cross reference. You can check that out from my classwork book. Yeah. By the end of this session, if I have time, then I will discuss a solution to this. Otherwise, you can just check out. I will be posting the solution of that question. I will be posting solution to this question in my Telegram channel along with the other solutions that I'm discussing here. Done? So question 2 is directly from our book. All you had to do was activity based costing. 2 products you have and variable cost of both products you were given. This and this, and machine setup cost, testing cost, you had to split between AXE and WI. Yeah, X and Y, I can say X and Y. You just had to split these costs between X and Y by activity based costing method. Engineering cost was already given split. Engineering cost was already given between X and Y separately, so only the other 2 costs, that is machine setup cost and testing cost, you need to make the cost driver rate. This is the total machine setup cost and testing cost. You need to calculate the total setup time, you need to calculate the total testing time, divide, get a cost driver rate and use that rate for adding overheads to the product cost. That's it. Yep. And then within that same question, they also asked something about target costing and they had some changes in the product, new design was created. Everything in this question is exactly from my classwork. Yes, so you can please refer to that classwork question for that. Question 3 was new and to save time I have written some partial answer on my page over here so that we can make a discussion a little fast. Yeah, let's see. Question 3. When Private Limited is a diversified agribusiness company having 3 different business verticals, so 3 divisions you can say: dairy, animal feed and crop protection. The performance of each division is measured separately and staff members are rewarded accordingly. Okay? The following information pertaining to financials for the year ended this are furnished below. You are given details of the company, you are given revenue for each division and you are given profit before interest and tax for each division. Okay? You are given net book value of plant and equipment, net book value meaning after depreciation, and you are given net current assets for each division. Look, plant machinery you are given for each division, current assets you are given for each division. If you add them both, the summation of these 2 will become your capital employed in each division. Yes, capital employed will be your fixed assets as well as the working capital. This is net current assets. Net current assets meaning current assets minus current liabilities. So this is basically your fixed assets plus working capital gives you the total capital employed. I've just added them up and written that total over here. This plus this total is 670 lakhs. This plus this total is 895 lakhs. and over here total capital employed. I've just mentioned the totals over here. Further, cost of capital of the company is given 9%. Okay. Profit before interest and tax, as mentioned above, has been arrived after deducting head office expense at 2% on the revenue of each division. Now this head office expense you must add back. Look, the question is about residual income and return on investment, and both of these, if you calculate division wise, then you should consider only the profit which is controllable by that division. You need to consider the profit controllable by the division. Well, the dairy division shows a profit of 60 lakhs 10,000, but this profit is after deducting 2% of revenue towards head office expense. Now head office expense is not in the control of the division. It is just apportioned to the division. Now because head office expense is not in control of the division, hence this head office expenses must be add back. Okay, so 2% of revenue in every department I add back towards head office expense. So if I calculate here, dairy division 60 lakhs 10,000 plus 2% of 680 lakhs. So 680 lakhs into 2% is 13.6 lakhs plus 60.10 lakhs gives 73.70 lakhs. This is the profit controllable by the dairy division. Same way, animal feed division, what I have done is this revenue into 2% I add over 6377. It gives me 85.05, and similarly here I get this. In short, your head office expense is add back. After adding it back, whatever I get, that is profit before interest and taxes plus the head office expense, it gives me PBIT controllable by the division. It gives me profit before interest and tax which is controllable by the particular division. Okay, now you have the profit controllable by the division and you have the capital employed in the division. Using these two factors you can calculate ROI and residual income. So first I calculate ROI. They have asked us later to find ROI. So this divided by this 73.7 divided by 670 gives me 11% ROI in a dairy division. Same way for animal feed division, this divided by this gives 9.5 ROI, and crop protection division, this divided by this gives 21.6% ROI. Done. So you have the ROI in every division, and it seems that crop protection division has the highest ROI. Then residual income also you calculate. Residual income, how do you calculate? Yaad karo. Residual income is basically this profit minus capital employed into cost of capital. Capital employed, you have these values. Cost of capital is given 9%. So my residual income will be this profit minus 9% of this 670. Let me start from that. This 670 into 9% cost of capital. 670 into 9% cost of capital is 60.3, and that 60.3 I deduct from 73.7 gives me 13.4 lakhs as residual income. Same way for animal feed, 85.025 minus 9% of 895, and for crop protection it will be 69.66 minus 9% of 322.5. It gives you 40.635. So chalo, this answers my first question. ROI and residual income I calculated. Let's see what they have asked. They've also said depreciation rate for plant and equipment is 15% on cost. But as of now, this is not needed because the plant equipment that you have been given is already net book value. Net meaning it is already after depreciation. Yes, so this one is already after depreciation. You don't need to do anything about depreciation yet. The divisional performance of the company is measured using return on investment and residual income methods based on the controllable profits of each division. Now this was important. That is why you added the head office expense. The staff members are rewarded based on these results. When calculates ROI and RI using net book value of plant and equipment at the reporting date. So you will consider the book value of net book value of plant and equipment of the reporting date, meaning closing plant and equipment. Yes, question. Sajal, your questions. No dear, capital employed has to include current assets minus current liabilities. Otherwise, you cannot call that as capital employed. Return on investment will be your return on entire investment. Working capital is also an investment. So look, you have to take current assets also. This sentence does not mean current assets is not to be taken. This sentence is simply given so that you do not add back depreciation and calculate opening plant and equipment value. Like you remember, for EVA calculation, economic value added, in EVA calculation you take opening capital employed. This sentence they have given to tell you that don't take opening capital employed, you take the capital employed at the reporting date, meaning the closing capital employed. Yes, so anyways, current asset minus current liabilities, working capital has to be added. This sentence does not mean that you skip adding working capital, because if you skip that, then it is not capital employed. If it is not capital employed, then you cannot call that as return on investment or residual income. Done? Yes. Okay. The manager of animal feeds division claims that their division is the best performing division of the company. You calculate return on income and residual income for each division and explain the validity of the claim made by animal feeds division. Well, that animal feeds division manager is saying that his division is best. Maybe he is saying that because of maybe he is stating that because his division has the highest amount of profit. But selecting best division based on amount of profit will be wrong. You look at the risk, you look at return on investment, then animal feed division has the lowest. If you look at the residual income, then again animal feed division has the lowest. So is his claim correct? Do you think that the claim of that animal feed division manager is correct? No. Which is the best division? Well, by both the methods, ROI and residual income, by both the methods, crop protection division seems to be the best. Done? Yes. Okay, many questions. I think many students have made a mistake over there itself. Prabin, you're asking, will we get marks if we take only plant machinery, because there is ambiguity in the question. I'm sorry to say, Prabin, but you will not get full marks if you had taken only plant machinery value there, because return on investment is always total investment. It has to be plant machinery as well as your working capital. It has to be the total capital employed. Yes, so you might not get full marks, but yes, don't worry, you will get marks for your efforts, for your calculations done. Yes, only one item you have missed out, that is fine. Yep. Sajal, no, I don't think what you are saying is true. When it comes to return on investment, it can never be based on only fixed asset. If it is based on fixed asset, it is not called return on investment. It is called as return on fixed asset. There are different names for those other measures. But when the name is return on investment, then it has to be the investment in fixed asset as well as working capital. Yes. Okay, I hope that solves your questions. Then part B of the question was interesting. Part A was just asking return on investment and residual income. You make those 6 calculations and say that the claim made by manager of animal feeds division seems to be wrong. Yeah. Part B. It has been proposed to expand the business of dairy division by venturing into manufacture of frozen desserts. Okay. This would require additional investment in plant and equipment of 175 lakhs. Okay, which will generate a contribution of 95 lakhs per annum. Annual fixed cost will increase by 8,50,000, which is excluding depreciation. So you need to still do minus depreciation in that. And the net current assets of this division will increase by 25 lakhs due to acceptance of this proposal. Look, again you notice your current assets are given. Why are they giving current assets? The current assets are given because it has to be considered in calculating ROI. No option. Yes. Okay. So now they're asking evaluate the proposal of expansion of the dairy division for a period of 1 year. Advise the management on the acceptance of the project using ROI and RI criteria. Yes. So what you can do is you can calculate ROI, RI for the dairy division because of this new additional investment. So first of all, let us calculate ROI of only the additional investment. You notice additional investment will give contribution of 95 lakhs per annum, and from that contribution minus the fixed cost 8,50,000. So contribution 95 lakhs minus fixed cost 8,50,000 and minus depreciation. Depreciation, you were told earlier, 15% is the rate, and this new investment requires plant machinery of 175 lakhs. So depreciation of 175 lakhs into 15% is 26 lakhs 25,000 is depreciation. Depreciation 26.25 lakhs. So let us identify what is the profit controllable because of this new investment. Well, this new investment or new proposal gives contribution of 95 lakhs. I'll start from there. 95 lakhs per annum contribution minus fixed cost of 8.5 lakhs minus 8.5 fixed cost and minus depreciation 26.25 gives 60.25 as your profit before interest and tax of the new proposal. Okay, and this new proposal requires investment of 175 lakhs. 175 is the value of plant and equipment. It is a cost of plant equipment. You are supposed to take the book value of plant equipment at the time of reporting. So from this 175 at the time of reporting there will be minus depreciation. So the net book value after depreciation will be 175 minus 26.25. 175 minus 26.25 is 148.75 plus the net current assets 25 plus 25 net current assets makes it 173.75 is your total capital required for the new project. So total profit of the new project is this, capital required in new project is this, divide, it gives you return on investment of 34.68%. Will the division manager accept the new proposal? Yes, definitely, because the return on investment obtained in the new proposal is much higher than the existing return on investment they have. So the manager will be more than happy to accept that proposal. Done? Yes. Okay. And similarly, residual income also you can calculate. Residual income will be this profit 60.25 minus capital into 9%. So capital 73.75 into 9% is 15.63. This you minus from 60.25. 44.61 is the residual income. As the residual income is positive, yes, it is positive, so the new proposal should be accepted, can be accepted. Done? Yes. Okay, that is answer to part B of the question. Part C. return on investment improves with the age of the asset. Explain this with calculation. Well, naturally, with the age of the asset, return on investment will improve. Why? Because say this was the return on investment in first year. Let us imagine what will happen in the second year. Well, in the second year, if I calculate return on investment for that same new proposal, in the second year, it will generate contribution of 95 lakhs because this was per annum. Per annum meaning every year it will generate 95 lakhs. Okay. Every year it will have annual fixed cost of 8.5. Okay. But every year will depreciation remain the same? No. Assuming that they follow, I think, WDV method. Let's see. No, they follow 15% on cost. On cost means SLM method. Okay? They follow SLM method. So meaning that every year depreciation amount will also remain the same, 26.25. So in the second year, contribution same 95. Second year fixed cost is same. Second year depreciation is same. So second year your profit controllable in the new proposal remains the same, 60.25. But my asset value in the second year will reduce. Yes, my asset value will now reduce because my net book value of equipment will reduce. My book value of equipment, which was 75 minus 26, will decrease by further 26. Yes, so 175 was my original book value, minus 26.25 in the first year, again minus 26.25 of the second year. Your book value will reduce. And assuming that the working capital remains the same, 25 lakhs, so plus 25 lakhs gives my capital employed for the new project. My new project capital employed now becomes 147.5. So let's see what will be the ROI. 60.25 divided by 147.5 makes it 40%. Yes, you notice that the ROI improves from 34%, it improved to 40%. So with calculation proved that with the age of the asset, ROI will improve because with the age of the asset, book value of the asset will decrease. So capital employed appears to be less. Capital employed will be less, denominator is less, so ROI percentage will appear to be more. Done? Yes, that is part C of the answer. And part D of the answer is exactly from our book. It is chapter 7, case number 7. Is exactly word to word from the book. Chapter 7, case number 7 had that same discussion, but it is a very general discussion there. So even if you did not study that question, still you should be able to answer. I've given a kind of answer here. Let's see. In addition to financial performance measures, the management wishes to apply non-financial measures also for 3 functions. They wish to apply non-financial measures for 3 functions, that is for management of human resources, for product and service quality, and for brand awareness and company profile. Explain the scope of non-financial performance indicators with regard to these 3 functions. So you needed to explain, give examples that which non-financial performance measures can you use for these 3 things. First, you write importance of the non-financial performance measures. Notice it is a 6-mark question. So you have to write some time pass more over there. First, you write benefits of non-financial performance measures. You mention that for each of these items, say human resource, you write what is the benefits of measuring performance of human resource management. You write that it is important to measure performance of human resource management because human resource are important in any organization. All those time pass you write. Then you write that how do you measure whether human resource management is good or not. You measure that by measuring, say, staff turnover, because if more people, more staff is leaving the organization, meaning your management of HR is not very good. You can measure that by absenteeism of staff, by labor turnover, that is chalo same staff turnover, etc. Secondly, product quality. How do you measure performance towards product quality? First, you write the importance of product quality. You write that product quality is the most important thing in any business. Customers require good quality products and all. Just write the general importance of maintaining a quality of product. And then you write down that how to measure the company's performance with respect to product quality. You measure the value added to the product. You measure that how much value the customer is ready to pay for the product. You compare your product with the competitors, whether your product is giving better features than the competitors and all. Yes, you identify whether company has done enough innovation in the products or not. All these are the factors how you can judge whether company has performed well or not. Okay. And third aspect, brand awareness. Brand awareness of my company. You need to write again importance, that it is important that customers are aware of my brand image. It is important that I maintain a good brand image of my company. And how to measure the brand awareness? Well, you can measure that by measuring customer loyalty. How many times the same customer is coming back? You can measure that by measuring the stakeholder satisfaction, whether shareholders are satisfied or not, whether employees are satisfied or not. All that matters to the brand image of the company. Yeah, you also measure that whether the company has patents and trademarks which will create a good branding of the company. Okay, these are the general discussions you can make over here. Done? Okay. Further, question number 4. Question 4A was exactly from ICAI study material. I have not discussed that in class, but it is a very general kind of question. You should be able to answer that out of your simple common sense. We'll see. INS Insurance offers a wide range of insurance covers for individuals, including a comprehensive range of term insurance products. It is planning to introduce the following changes. So the company is into insurance business. Okay. It's planning to introduce the following changes. Option of paying insurance premium in installments, that is monthly, quarterly or half yearly, as well as annually. But company adds a surcharge of rupees 50 per payment if the customer choose a mode other than annual payment. If you choose to pay annual premium, then I don't charge any extra money. But if you choose to pay monthly premium or quarterly or half yearly premium, then I will charge 50 rupees per payment. Is that a logical extra charge? Yes, in my opinion, it is very much logical. Why? Because naturally, if I am getting the premium amount from my customers one time, if I am getting the entire annual premium from the customer together, then I will save interest cost. But if I am allowing the customer to pay premium on a monthly basis, meaning my entire annual premium is not obtained together, it will be obtained month by month. So it will take almost 1 year for me to collect that annual premium. In short, if the customer is paying late, then it is very much logical that you charge 50 rupees extra. Plus, in case of monthly premium, monthly payment, there will be more admin cost also. You will incur more transaction costs, more administrative costs. You will have to keep a track that which customer has paid how many months premium, how many months is pending and all. So in short, your admin work will also increase. So it is very much logical that yes, you charge little extra money if they choose any option other than annual payment. Yes, it is justified. They are asking whether these extra surcharges are justified or not. I say yes, justified, and you write explanation that why it is justified to charge 50 rupees extra, because mainly because of two things: interest loss and because of extra admin cost you will incur. Done? Yes. Second, an incentive to customer. They are planning to give incentive to the customer at 0.75% of the premium amount or rupees 300, whichever is lower, per payment if the customer opt for ECS facility. Well, ECS is like electronic clearance system, in which the premium amount will be auto debit from the customer accounts. It will lead to auto debit of premium from the customer accounts. Now, if this leads to auto debit, then naturally it will speed up your collection process. and it will simplify your admin work also. You don't need to remember that whose premium is pending and all. Yes, so because it will ease your operations, it is justifiable that you give discount. You can give incentive, meaning discount, for those customers who choose the ECS facility. Yes, that is also justified. Done? Yes. Okay. Then question 4a or question. Now this question is a direct question where they are asking you to classify that which activity given here falls under which category of the Porter's value chain analysis. Porter's value chain analysis has primary activity, secondary activity. You just need to choose that which activity falls under which category here. The company is a law firm. It is a law firm. It is like a practicing law firm, and they have given various activities of the law firm. You just have to relate. Well, this is my answer. First activity, dealing with claims of negligence by customer. Well, customer negligence claims. Look, it is a law firm. It is a law firm, and if the customer is claiming negligence by my firm, then this is like a part of after sales service. This is a part of after sales service, so it relates to the service activity of value chain. Then central control system that ensures each case is independently reviewed. It is talking about a control system. Control system is mainly a part of the firm's infrastructure. Yes, it is not like the physical infrastructure, but it is like the admin infrastructure. Okay. Attending court cases. Well, for a law firm, attending the court cases is the main operations. That is the main operations of the law firm. Okay. And receiving strong data from client meetings. You meet a client and receive data from that client meetings. That is like input. That is like inbound logistics. Because for a law firm, it is a service industry. Inbound logistics, they don't get materials, but they get information from the customers. So getting materials is inbound logistics. For a law firm, getting data from client meetings is the material. That is the inbound logistics. Done? Yes. Okay. They've asked to define value chain for 1 mark and identify which activity relates to which dimension. We discussed that. Further, question 4b. Question 4b is again from ICAI study material, page 4.57, question number 7. It's not there in my book, but it is a very general discussion. It's a very general kind of discussion. Even if you have not read this, you should have been able to create a very generalized answer there. We'll see. It's about environment management accounting. Pertaining to environmental management and sustainability, there are following two situations. Situation 1. Packaged food manufacturer XYZ Limited was ordered to submit a yearly report to Ministry of Environment and Forest on activities which contains information concerning collection, recovery and recycling of packaging waste, fulfillment of targets, volume of recovered and recycled packaging waste by type of material, and declaration that all compulsory contributions and taxations have been paid. Okay. Now for this situation 1, they are asking question 1, that explain risk exposure of XYZ Limited. Does this company have any risk? Well, we are supposed to answer with respect to environment management. Well, yes, this company has a risk because in case of environment management, we talk about environment risk. Environment risk, that the ministry has ordered them to submit a yearly report on these things. Now, if you are submitting a yearly report on these activities, in these activities, if there is proved any environmental damage, if it is proved based on your activities that you have done some environmental damage, then you will have to face legal penalties. You'll have to face financial penalties and all. Yes, you may have to face litigation. You may have to pay penalties and fines and etc. These are the risk involved. Simple. Yeah. Second situation, ABC Limited has achieved a 30% reduction of energy consumption through its Go Renewable initiative. Okay. For the company, a 30% reduction represents cost saving of 25 lakhs. Okay. So by switching over to renewable energy, they saved 25 lakh rupees. That is almost 30% reduction in the cost. Okay. Now for this situation 2, they are asking question 2. How focusing on environmental sustainability provides opportunity to ABC Limited for reducing a cost? Again, a very general discussion you have to make. There is no particular answer to be given here. Just talk about general things that yes, focusing on environment sustainability can help them reduce the cost. You see that by focusing on renewable energy, they saved 25 lakh rupees. That is a huge savings in the cost, 30% savings in cost. Then similarly, by focusing on various other environmental factors also, they will have further savings in cost. Yes, you can give examples that if you focus on better environment sustainability, then you can have savings in cost by reducing fines and penalties. Government is charging various types of penalties for environment damages. If you stop environment damages, then that fines and penalties will reduce. Plus, you might be able to discover some new technology which will save environment. Then that new technology, if it saves environment, it will not just save your fines and penalties, but you can even sell that new technology. You can patent and sell that new technology to other companies also. Yeah. Now, if you are saving environment, meaning you are accumulating carbon credits. I hope you remember what is carbon credits. And if you accumulate carbon credits, you might even sell that carbon credits to other company and increase your revenue. In short, these are the ways how you can reduce cost by taking care of the environment. Done? Yes. Okay. Question 4C is about multinational transfer pricing, and this question is again very much similar to our classwork question. Chapter 8 question 26 is also exactly like this question. Only difference is that this classwork question was between 2 divisions, while this question here is between 3 divisions. Okay, not an issue. You have 3 divisions. I'll just summarize the question. It's a long question. You have 3 divisions: Malaysia, Singapore and India division. Your raw material starts being processed in the Malaysia division. Malaysia division then gives the product to Singapore division, and Singapore division gives the product to India division. India division then sells the finished goods to the final customer. Yes, so you notice here there are 2 transfers involved. Let me call this as transfer 1 and I call this as transfer 2. 2 transfers are involved. Malaysia division transfers to Singapore, Singapore division transfers to India division. Okay. You are given the cost details of every division. Malaysia division, variable cost, fixed cost per unit you are given. Singapore division, variable cost, fixed cost, and India division, variable cost, fixed cost are given. All costs are given in the respective country currency. What we can do is we will convert everything into rupees, because they are asking us to prepare division wise profit statement. Now divisional profit you can compare if it is in same currency. What I will do is I will convert everything into rupees itself, so that it is much more easier to compare. Okay? And you are given the exchange rates over here for that matter. Okay? Your income tax rates are also given for Malaysia, Singapore and India division. Okay, and they say each tablet computer, that is final product, is sold to retail stores in India. So India division is selling the final product at 19,000. So selling price of final product is given. Foreign exchange rates you are given, and this last paragraph here is basically giving you market price. The market price of the product of Malaysian product in Malaysian market is 147 Malaysian ringgit, and the market price of that Singapore product in Singapore market is 134 Singapore dollars. Okay, so you are given the market price of those products. I can just mention that here, that for the Malaysian ringgit, for the Malaysian division, the market price of his product in the market is 147 Malaysian ringgit, And for the Singapore division, the market price of his product in the market is 134 SGD. And for the India division, they are selling it in the external market only, and their selling price is given rupees 19,000 is the selling price in the external market. Okay? And they're asking you to calculate what? They're asking you to calculate after tax operating income per unit earned by each division. In short, you have to make division wise profit statement. Yes, you just have to make division wise profit statement for 1 unit per unit of transfer. So you make a profit statement if Malaysian division transfers 1 unit to Singapore, further Singapore transfers 1 unit to India, and India will sell that 1 unit in the external market. You just need to make a profit statement like that. Done. And for that transfer, they have suggested following the transfer pricing method as market price method or 200% of full cost method. Chalo, theek hai. Market price you are given. So by market price method, these are the transfer prices. ठीक है. By full cost method, second method, they say you transfer based on 200% of full cost. Now full cost of the Malaysian division is this plus this into 200% and into 17 rupees, because we'll convert everything into rupees. Yes, I'll show you the workings. Dekho, I've drafted a solution for that entire question here. First of all, I decide the transfer price by market price method. Transfer price based on market prices 147 MYR and 134 SGD. I convert them into rupees and I get the transfer price in rupees. Okay? But by full cost method, I need to give more efforts. My transfer 1 is Malaysian division giving to Singapore division. Malaysian division has the full cost of 30 plus 60 ringgits. And into 17 rupees converts that into rupees into 200% gives me transfer price of the first transfer. Look, raw material goes to Malaysia division, Malaysia division transfers to Singapore division, Singapore division transfers to India division, and India division gives out the finished goods. This is my transfer 1, this is my transfer 2. For this transfer 1, my TP1 is applicable. So for that transfer 1, it is 30 plus 60 ringgits into 17 rupees gives the rupee value of the cost, 200% of the cost. For the transfer 2, you have to be careful. For transfer 2, 200% of cost will transfer to cost will also involve the cost of materials obtained from transfer 1. Yes, so for transfer 2, this 3230 materials given by Malaysia to Singapore, that becomes a cost. Plus the cost incurred in Singapore division is 35 plus 47 SGD into 50 rupees. This is the cost incurred in the Singapore division, plus this is the material cost of the Singapore division. This becomes total cost of Singapore division. 200% of total cost becomes rupees 14,660. Well, the most important part in this question was this calculation. If you get this right, then rest of the part is very much easy. I hope you understand this. Yes. Okay. Then they have asked to make a profit statement. I have made a very simple profit statement here. First profit statement where transfer is by market price method. So in that case, my transfer price is 24996700 rupees. Everything is in rupees. I've already converted the transfer prices to rupees. So now everything else also I will convert into rupees. Malaysia division has transfer sales 2499. Malaysia division has a variable cost of 30 ringgits at rupees 17 is this, and 65 ringgits fixed cost at rupees 17 is this. Gives me profit minus tax of Malaysia will give me profit after tax. Should get 583.44. Similarly, Singapore division has no external sales but transfer sales only you show at 6700, that is the transfer price, plus 2499, the transfer sales of Malaysia becomes transferred material for Singapore. Okay, so for Singapore division 6700 is the transfer sales, 2499 is the transferred material. Other variable cost in Singapore is 35 SGD, fixed cost 47 SGD into 50 rupees gives the rupee value of variable cost, fixed cost in Singapore division. Minus all that gives you profit, minus 17% tax gives you profit after tax. Done? Yes. Okay. And for the India division, 19,000 is the external sales, minus the transfer cost 6700, minus other variable cost, fixed cost already given, gives you profit, minus tax gives you profit after tax. So overall profit after tax 8216. This is your operating income per unit when transfer is done by market price. Second, if transfer is done by 200% of cost, if transfer is done based on 200% of cost, then sales, external sales of India division remains the same, but transfer sales values are changing. You can notice them here. Similarly, transfer material costs will become that way. Your other variable cost, fixed cost remains the same, exactly the same. And accordingly, you have profit minus tax, profit after tax, overall profit. These were the questions. Done. And they were asking that which method gives better overall profit. Well, better overall profit you see is in 200% cost method. Here your overall profit is only 8216, your profit is 8728. So yes, you are getting better overall profit under the cost method. That's it. So that is the question. Back to the question. They were asking you to calculate operating income per unit. We did that. And they were asking you that which transfer pricing method will maximize the after-tax operating income. Done? Yes. I will be posting the solution on the Telegram channel, so that if you wanted more details of the calculation, if you want to see that again, you'll see that on the Telegram channel. Right now, I'm just giving you a brush up of the entire paper. We need to complete the entire paper, so we are pushing a little fast. Done? Yes. Okay. Next, question 5. Question 5 is similar to some questions we have done in theory of constraints. Chapter number 2, question 11 we have done. It is exactly like theory of constraints question in chapter number 2. In fact, the first 2-3 questions here are exactly same as that classwork question. Remaining questions in that, these next 3 questions are of further extension, but they are also understandable. Let's see. You see, your company manufactures motor rotors in 2 operations, casting and bonding. Yes, so both divisions are required to produce your final product, motor rotors. Okay, your annual capacity of both divisions are given, annual production in both divisions is given. But you notice these numbers here, it shows that your casting division has spare capacity, but your bonding division is already operating at full capacity. Yes or no? Yes. So it means that your annual production is restricted to 60,000 units because bonding division has capacity of only 60,000 units. This is the most important observation of this question. You should explain this in your answer first. You explain that a bonding division is a bottleneck division. You explain that bonding division here is the bottleneck division. My total production of the company is restricted to 60,000 units because bonding division has capacity of only 60,000 units. Okay? Fixed cost excluding direct materials you are given for casting division and bonding division. Please notice this is fixed cost. They have also converted fixed cost into per unit. Fixed cost is converted into per unit. This 240 divided by 60,000 units or 150 divided by 60,000 units, it gives them fixed cost per unit. But you should know, you should have better understanding that this fixed cost per unit is of no use. Is of absolutely no use at all. In the later part of the question, they are trying to get you confused. They are confusing the student by writing fixed cost repeatedly at different places. But you should better realize that fixed cost is of no use. Fixed cost per unit is of no use at all. Total fixed cost is there. Now whether I produce less units or more units, whatever I do, this total fixed cost is not going to change. So whether I produce more units or whether I produce less units or whether I outsource my production to another company, in any case, this total fixed cost is not going to change. Do remember that. Total FC will not change in any case because it is a fixed cost. Okay? Read further. Each motor rotor sells for 3,600. So selling price of final product given. Direct material cost is 1,600 incurred at the start of the casting operation, and the company has no other variable cost. So materials is the only variable cost. Selling price 3,600, variable cost 1,600. So contribution per unit 2,000. Simple. And you remember that under the concept of theory of constraints, we've learned in theory also that under the principles of TOC, materials is the only variable cost. Same thing over here. And they say that company can sell whatever output it produces. This means that there is infinite demand available. If there is infinite demand, why are you selling only 60,000 units? Because your bonding department is the bottleneck. It has maximum capacity of only 60,000. Okay? You're required to consider the following situations independently. So each situation independently, they have asked you a question. Let's read. First question. DSA is considering using some modern jigs and tools in the bonding operation that would increase the bonding output by 750 units. Is it advisable to increase output of bonding division? Well, should be advisable because right now your bonding division is the bottleneck. Right now your production is restricted because of the bonding division. So if it is possible to increase production in bonding division, then it might be a good deal. Let's check out. So if you increase bonding output by 750 units, you can increase total output by 750 units. Yes, because your casting division already has spare capacity. And casting division does not have any variable cost. Only fixed cost is there. Okay? So in short, casting division has spare capacity. If bonding output can increase by 750 units, annual cost of these jigs and tools is 11,25,000. Should the company acquire these tools? Show your calculations. So let me give you a calculation. That 750 additional units will fetch contribution of rupees 2,000 per unit. Because of this new production, because of extra 750 units production, will your fixed cost increase? No, but your fixed cost will increase only to the extent of this 11,25,000. So this contribution minus 11,25,000 extra fixed cost should give you the profit. So check out 750 into 2,000 is 15 lakhs minus 11 lakhs 25,000 is 3 lakhs 75,000. So your decision, should you acquire these tools? Answer is yes. Should you do expansion of the bonding capacity? Yes. Second question. Similar second question dekho. This time they say that you can increase annual capacity of the casting department by 7,500 units. Should you do that? Well, frankly, no. Look, your casting department, why would you increase capacity of the casting department? Your casting department is already having a spare capacity right now. Your casting department is already having 15,000 units spare capacity which you are not able to utilize. If you increase the casting capacity by another 7,500, will you be able to utilize it? No, because bonding division is already at full capacity. Yes, so increasing the capacity of the casting division is of no use because bonding division will not be able to process that units further. So I can say over here directly answer is no. That should you increase capacity of casting division? No, because casting division is not a bottleneck division. Third question. An outside contractor offers to do bonding operation. This is like subcontract offer for the bonding operation. For 9,000 units at rupees 500 per unit. Now they are trying to confuse you. Now they are saying that the subcontractor is offering 9,000 units of bonding operation at rupees 500 per unit, which is double rupees 250 per unit that cost to DAC. Well, they are telling you that your cost is 250, but that 250 is this 250. It is a fixed cost. It is of no use. So ignore that 250 is a fixed cost. Ignore. If the subcontractor is offering you 9,000 units bonding at rupees 500, should you choose that? I'll say yes, you should choose that, because on each of those 9,000 units, for each of those 9,000 units, do you have casting capacity? Yes, casting department had 15,000 spare capacity. Do you have materials for 9,000 units? Yes. So for these 9,000 units, you will get contribution of 2,000 rupees minus 500 bonding cost. Each of these 9,000 units will still earn a contribution of 1,500. So if the bonding work is outsourced, it will cost you 500 rupees extra. Okay, your contribution is still 2,000. So from 2,000, can you tolerate extra 500 cost for bonding? Yes, you can. It will give you still total positive contribution. So should the bonding subcontract be done? Yes. In short, I can simply say that if anything can increase your bonding capacity, then you should do that, because bonding department is your bottleneck. So if you can increase your bonding capacity by purchasing some jigs and tools, yes, you should do that. If you can increase bonding capacity by outsourcing to a subcontractor, yes, you should do that. But similarly, if there is an outsourcing offer to do the casting process, should that be done? No, because what is the meaning of outsourcing casting work when you already have spare capacity in casting department, which you are not utilizing because your bonding department is already at full capacity? So if there is a company who offers outsourcing of casting process 3,000 units at rupees 200, the 200 is half the rate that it cost me. But again, that 400 cost, I told you it is a fixed cost. Therefore, ignore. because whether I outsource or whether I don't outsource, my total fixed cost is not going to change. I hope you understand that. You've learned that in the principles of relevant costing. Same thing applies here. So should I do outsource of casting process? Answer is no. Further, assume that the company produces 1500 defective units at the casting operation. What is the cost to DAC of the defective items produced? Explain your answer briefly. If the casting division produced 1500 defectives, then does casting division have spare capacity to replace that with good units? Yes, casting division has enough spare capacity. So if they produce 1500 defective units, then they can produce another 1500 units. Another 1500 units they can produce to replace the defective units. Yes, so the cost incurred will be only the cost of producing extra 1500 units. Yes, so in that case, my cost will be involving only the cost of producing extra 1500 units. Now what is the cost of producing extra 1500 units? Extra units के लिए do you incur any extra fixed cost? No. So for extra units, what you will incur is only extra material cost. Only extra material cost, that is 1500 units into what was material cost? 1600. Done? Yes. Okay. That is 0.5 and 0.6. Very interesting. Dekho 0.6. Assume that company produces 1500 defectives in the bonding operation. Well, if bonding operation produces 1500 defectives, then do you have capacity to do bonding of another 1500 units there? No, because bonding operation is already at full capacity. So do you have possibility to do bonding of extra 1500 units? No. So if there is 1500 defectives in a bonding operation, then what is the cost that you incur? Well, in that case, your cost incurred will not be just the material which you waste, but will also be the contribution that you lost. Yes, so your cost will be 1600 rupees material wastage plus plus 2000 rupees contribution lost. Both will be your problems then. Done? Yes. Into 1500 units. Okay, that is your question 5A. Next question 5B. Question 5B is a simple theory question. I'll not be discussing that. It's a very simple theory question about, I'll show you. about budgets chapter, beyond budgeting. They're asking you what is concept of beyond budgeting. They're asking you characteristics of beyond budgeting, principles of beyond budgeting. These all are direct questions from the book. You can refer that in the book. And last question, question 6. Last question 6, part A, is about simple make or buy decision. We'll study. Just a minute. My pen is not responding. Just a minute. I'll try to restart this thing. Okay, question 6. We'll read. RST Herbals Limited, which manufactures and sells a highly successful line of herbal home care and herbal personal care products, has decided to diversify in order to stabilize sales throughout the year. They are planning to introduce only one new product for now. They are planning to introduce, and that new product is immunity booster drink IM9. Selling price is given that for a box of 24 bottles, you'll sell it for 240 per box. The 240 per box is the selling price given. This new product does not have any additional fixed manufacturing overheads. So as such, new product does not involve any fixed manufacturing overheads. They have clearly mentioned. But however, rupees 27 lakhs charge for fixed manufacturing overhead will be absorbed. Look, overheads charged, absorbed. These words mean that these overhead cost is not a relevant cost. This will not be a part of my relevant cost, because fixed cost is relevant only if it is actually extra incurred. Fixed cost is relevant only if it is extra incurred for the new product. In this case, for the new product, there is no extra fixed cost actually incurred, so fixed cost is not a relevant cost. They have absorbed the fixed cost as 27 lakhs for 1 lakh boxes. So if 27 lakh fixed cost is absorbed for 1 lakh boxes, this is not relevant cost. You need to remove it. 27 lakhs for 1 lakh boxes, meaning 27 per box. Yes, so the manufacturing overheads they have mentioned here, 42, contains 27 per box fixed cost, and remaining 15 per box is variable. Done? Yes. So these are the cost details of the new product given. They have estimated 1 lakh boxes of the new product, for which material, labor, variable manufacturing overheads you have. Fixed overheads are absolutely not relevant here. Okay. Okay. Further, the costs above include cost for producing both immunity booster and a small bottle that contains it. So the company is not only just producing that immunity booster, they are also producing a small bottle which contains that immunity booster. ठीक है? As an alternative to making the small bottle, the company has approached a supplier to discuss possibility of purchasing the bottle. So yes, now you realize that the question is about make or buy, but it is not make or buy of the drink. It is make or buy of the bottle. It is not make or buy of the drink as such. It is about make or buy of the bottle which contains the drink. The question is about make or buy of the empty bottles. Okay. The purchase price of empty bottle from a supplier would be 40.5 per box. I can say this becomes relevant cost of buy. This is my relevant cost of buy that you are given, 40.5 per box. If RST accepts the purchase proposal, then direct labor and variable manufacturing overheads. You notice now they have clarified variable manufacturing overheads. Good that we separated variable and fixed overheads here. Yes, so they have now said that if the proposal to purchase empty bottles is accepted, then labor and variable manufacturing overheads would reduce by 10%, meaning that 10% was relevant cost of making empty bottles, and direct material cost will reduce by 25%. So it means that out of these costs, it means that out of these costs of the drink that you are given, these are the relevant costs of the drink. But out of these relevant cost of drink, how much is relevant cost of the empty bottle? Now we are told that out of these relevant costs of the drink, my cost of bottle my relevant cost of only the bottle is how much? Well, my relevant cost of only bottle is like this. Out of 108 rupees material cost here, if bottles are ready-made purchased, then material cost will reduce by 25%. So out of 108 material cost given here, 25% pertains to the cost of bottle. Yes, we've done such question in class that whichever cost is avoidable, that part is relevant cost. So 108 into 25%. Then labor and overheads is 10% of labor 60 and variable overheads 10% of variable overheads 15. It gives me my relevant cost of empty bottle. 108 into 25% is 27 plus 6 plus 1.5, 34.5 becomes my relevant cost of making the empty bottle. Yes, relevant cost of bottle make, I can say. So ठीक है, that answers my first question. चलो, should the company make or buy the bottles? If you make the bottles, it's costing you 34.5. If you buy the bottles, it's costing you 40.5. So my answer is that yes, I should make. Make is better. Done? Yes. So first answer, make is better. Second answer, what would be the maximum purchase price acceptable to the company? Well, if my relevant cost of making the bottles is 34.5, then maximum purchase price that I will be ready to pay will be anything less than 34.5. I will not pay purchase price more than 34.5, because if purchase price is more than 34.5, I will rather make my own bottles. Yes, the maximum purchase price you can pay should be anything less than 34.5. Okay. Third question. Instead of sales of 1 lakh boxes, if revised estimate shows sales volume of 1,20,000 boxes. Okay. Instead of 1 lakh units, if you can sell 1,20,000 boxes, at this new volume, additional equipment must be acquired to manufacture bottles at an annual rental of 12 lakhs. So you need additional equipment. You need equipment at annual rental of 12 lakhs because your volume has increased. Okay? Assuming that the outside supplier will not accept order for less than 1 lakh boxes. So if you are thinking that only 20,000 boxes you buy from the supplier, no, supplier will not accept any order less than 1 lakh units. The minimum order quantity is 1 lakh. You have to order minimum 1 lakh. Yep. Should RST Herbals make or buy the bottles? Now they're asking, should you make or should you buy? Well, you can compare like this, that if you make your own bottles, if you plan to make the bottles, then for making the bottles, for making 1,20,000 bottles, for making 1,20,000 bottles, you will have to spend 12 lakh rupees extra. So 12 lakh rupees you are spending extra for 1,20,000 bottles. So per bottle 10 rupees extra cost you are incurring. So my relevant cost of make, which was 34, will increase by 10 rupees, it becomes 44. While my relevant cost of buy is still only 40.5. Now I will say which is better. Now you say buy is better. So you should buy all 1,20,000 bottles. Done. You should choose buying for all the 1,20,000 bottles, because anyways the supplier will not supply anything less than 1 lakh bottles. Done. Okay. And it doesn't make sense that you buy exact 1 lakh bottles and for 20,000 bottles you make. Why? Because just for 20,000 bottles if you plan to make, then you may not, then this 12 lakh might not be affordable. Yeah. Anyways, but the point is that yes, 1 lakh bottles you can choose to buy, because if you plan to make that, then you will have to spend rental of this 12 lakhs. So my decision here is that buy is better. At least for 1 lakh bottles, your buy is better. Done. That is third answer. Fourth answer, refer to third answer, third data above. Assume that outside supplier will accept an order of any size. So now they are changing. The supplier is ready to give you less than 1 lakh bottles also. Well, in that case, he is now charging extra rate of 48 per box. So now instead of giving at 40, he is giving at 48. So okay, I can say that my cost of make is still less. So what I can now suggest in this fourth answer, what I will suggest is that you make 1 lakh bottles. You make 1 lakh bottles because that 1 lakh bottles you can make without additional equipment, and remaining 20,000 bottles you buy. Remaining only 20,000 bottles you buy. Makes sense, because anyways that 20,000 bottles if you plan to make, then only for 20,000 bottles you will be spending 12 lakh rupees extra. Imagine you are spending 12 lakhs for only 20,000 extra bottles. If you spend 12 lakhs for only 20,000 extra bottles, 12 lakhs divided by 20,000, practically you are spending 60 rupees extra for each bottle. So naturally in that case buy is better, because he is giving you at only 48 per bottle. Done? Yes. Okay. And the fifth one, what qualitative factors should the company consider determining whether they should make or buy bottles? Well, you remember I have told you, I've explained to you in my regular class, even in my revision classes, I have told you that for every question of make or buy, when you write analysis, you always suggest that in case you choose the buy option, then there is always a risk that the buy quality may not be as good as your make quality. You always comment that the quality of buy has to be good. You comment that you should check the quality of buy, and all those things you should mention in your answer. Done? So in short, qualitative factors you should mention in your answer. That's just a theory question. Done? Yes. Okay. And the last question, question 6b. Now this is a very much different question. We don't have enough time for the entire question, but I'll just give you a summary of the entire question. They have given you budgeted factory overheads, budgeted fixed overheads you are given, total factory overheads incurred you are given, so that is considered as actual. I had planned to solve this entire question, but it will take time. I will just give you an overview of the question because I cannot extend beyond the time allotted. Variable factory overhead rates you are given, these are considered like standard rates. Per setup per machine hour you are given, ठीक है. Total standard machine hours allowed you are given, so standard hours you are given, actual hours you are given, and actual quantity of number of setups you are given. These are all the data available. So you notice that you are given fixed overheads as well as variable overheads, and you notice that there are two types of overheads: setup overheads and other overheads in fixed. And variable overheads also has two: setup overheads and overheads which is per machine hour. Let's say that is other overheads. Okay? And required, they've asked you to compute total overhead spending variance. Spending variance is nothing but your budget variance plus rate variance. Fixed overhead budget variance and variable overhead rate variance. It's just another name. They're asking you total, so fixed as well as variable, and I can say this is fixed overhead budget variance plus variable overhead rate variance का combination. ठीक है? Then efficiency variance they are asking, but you notice here they don't say total overhead efficiency variance. So for this we can calculate only variable overhead efficiency variance, because efficiency variance is more likely in variable overheads. And total overhead flexible budget variance. Flexible budget variance is like the total cost variance. Chalo, I'll answer that part 1 of the question. Then part 2 accordingly you should be able to answer. Part 1, for that I'll first show you a kind of data table. My data table will have budget data, standard data, actual data. First, for the fixed overheads, well, my fixed overheads budgeted fixed cost you are given. What you are given are the budgeted fixed costs, 96,000 and 3 lakhs. $96,000 is the setup overheads, other overheads 3 lakhs. Okay? And in case of variable overheads, you can mention separately quantity, rate, amount. Okay? So for variable overheads, notice Let us start putting up all the data. Your actual overheads, you are just given total. You're not given actual, variable and fixed separately. Actual overheads only, total given 7,20,000. So I'll mention that here. In my actual overheads, actual fixed overheads amount I don't have, actual variable overheads amount I don't have, but the actual total overheads is 7,20,000. In variable also there is a setup and other overheads, let's say. Okay. Then variable factory overhead rates you are given. Well, variable rate you are given, that must be the standard variable overhead rate. Variable rate standard per setup and per machine hour 907.5. I'll use that here. So my variable overhead rate per setup is rate column 900 per setup and 7.5 per hour. You can use that in standard, same you can use in budget also. 900 per setup, 7.5 per hour. Okay. Total standard machine hours allowed. Machine hours allowed, meaning these are the standard hours. 45,000 standard hours you are given. The standard hours is 45,000 hours. In fact, we missed out at the beginning of the question. You are given the budgeted hours also. Your budgeted matlab practical capacity 48 setups and 48,000 hours you are given to manufacture 9,600 units. These are all your basic budget given. So my budgeted data is of 9600 units. It pertains to 48 setups and 48,000 hours is the capacity given. My standard hours is given 45,000. So my standard number of setups should be 45 setups. You can then cross multiply there, that if 48,000 hours is in 48 setups budget, then 45,000 hours should be 45 setups budget. Okay? If 48,000 hours produces 9,600 units, then 45,000 hours must be for how many units? Well, that also you can cross multiply and identify that this must be you'll get this as 9,000 units, meaning actual production is 9,000 units. Done? Okay. I'll just try to fill up as much details as possible in the data table. Then actual hours and actual quantity you are given. I'll use that in my data table. Actual number of setups is given 42 setups and actual hours is given 52,500 hours. You can use that for the two types of variable overhead that we have. Okay, these are all the data which we have. Okay. Now with this data, can you identify the standard amounts over here? These standard amounts, yes, you can find 45 setups into rupees 900 and 4,500 hours into rupees 7.5 will give you the amounts over here. Yes, these amounts you can find. Similarly, can you find the standard fixed overheads also? Yes, you can find 9,600 units is this. Then 9,000 units should be what? You can find that. So these items you can find, these items you can find. Add them all up. Will give you the total standard cost, and I've made the workings, should get total standard cost as 749 250. Yes. Now total standard minus total actual will give you the total flexible budget variance. Total variance or total variance is this difference, 749 250 and 7,20,000. That difference is your total variance, whose answer is, according to me, 29,250. Favorable. Okay. Then overhead spending variance is combination of these two. Well, that will need some efforts. Check out. Will be fixed overhead budget variance and variable overhead rate variance. Fixed overhead budget variance will be budgeted fixed cost minus actual fixed cost. Okay. And variable overhead rate variance. Remember the formula. Variable overhead rate variance is standard hours into standard rate minus actual rate. Well, this formula, if you open up and multiply things inside, it will give okay, just a minute, my mistake here. This has to be actual hours in the rate variance, my mistake. So it gives me actual hours standard rate minus actual hours actual rate. Now notice, actual hours actual rate will give you actual variable overheads. Actual fixed cost is the actual fixed cost. So can I say that this actual fixed cost and actual hours actual rate, these two is equal to total actual overheads? And yes, that total actual overheads you have 7,20,000. Total actual overheads you are given in the question, so that solves it. And budgeted fixed cost you have actual hours standard rate. You have actual hours standard rate are these actual quantities into these standard rates. Actual quantities are these multiplied by these standard rates. Done? Yes. So my answer there could be like this. Budgeted fixed cost is total 3,96,000. 3,96,000, yes, plus actual hours into standard rate. There are these actual quantities into these standard rates. Both items you will take. Actual hours standard rate and 52,500 hours into rupees 7.5 standard rate, and minus total actual overheads 7,20,000. Well, check this. If you do that, should get answer as, according to me, your answer should come as 1,07,550 favorable. Yes. And the third answer is they are asking variable overhead efficiency variance is like variable overhead time variance. Well, for variable overhead time variance, you have everything that is required. Variable overhead time variance formula, you remember, should be what? For variable overhead time variance, your formula is standard rates multiply by standard quantities minus actual quantities. Standard rates you have both categories, standard quantities you have, actual quantities you have over here. Can get the variable overhead time variance, and according to me that answer should come as 53,550. Done? Yes, that is answer to part 1, and accordingly similarly part 2, well, you need to solve on your own. Done? Yes, that is almost my entire paper. Last question is the direct theory question about factors to be considered while investigating variances. You'll find that in my book. I've written the page numbers. You'll get that in the book. Done? Yes. So that is your paper over here. I hope that paper discussion you found little useful at least. Yeah. Anyways, for the new students, for the next batch students, all the important questions from this paper will get incorporated in the next material whenever I will launch my next material. Done. But on the whole, that was the paper, and according to me, it was a pretty good. Enjoyed the sessions, and do join the regular classes on Unacademy if you enjoyed the sessions. Done. That's all. Thank you very much. See you. Bye bye.